Hi, I'm Steve Cusin, and welcome to another installment of Minds on the Markets, this groundbreaking series in which we take teachers and students on virtual field trips to the financial capitals of the world. Our guest today is Mr. Sal Sodano, Senior Executive Advisor to the President here at Hofstra University. And our format's a little bit different today. I'm going to ask the first question, but after that we have an audience of students with us, and they're going to take over from there. So let me start by asking you, tell us a little bit about your educational background.
Sure, Steve, happy to do that. I'm a product of Hofstra University, where we are right now. I studied and earned 2 degrees from Hofstra University. My undergraduate degree was a degree in accounting. I had a minor in economics. And later on, not that later from my undergraduate degree, I studied to earn an MBA in finance. So I'm at home right here at Hofstra.
Now, after you left Hofstra, you had a very renowned career on Wall Street. Could you tell us a little bit about that?
Well, let me start, I guess, from what happened right after Hofstra, because it all began with my business career at Price Waterhouse. I was recruited off of campus from here at Hofstra University to Price Waterhouse, and I started as an accountant, and I think that's important. Accounting to me is the language of business, the foundation of really understanding how business works. So I was happy to have that opportunity. I was hired away from Price Waterhouse by one of my clients to one of our clients to JP Morgan. Excellent experience. I did work in the treasury area, foreign exchange management, cash management, funded our euro-dollar loan book, so I was finding ways to make sure we did a good job on funding all our loans. Did some accounting related work as well. Then after a number of years was recruited away from JP Morgan to Bankers Trust Company. And ultimately, I became the person who was the head of global finance. And what that means is the person who oversaw and looked what all the chief financial officers throughout the Bankers Trust network was doing. And Bankers Trust, which is now part of Deutsche Bank, was a huge organization with offices all throughout the world. So it was a tremendous opportunity. I was a relatively young guy. Got to see how a cutting-edge financial institution really works. Made tremendous inroads in terms of understanding how both the money markets and the capital markets worked. So I did that for a number of years. Had the opportunity to go over to a $100 billion merchant bank. I was hired away to a company called Westpac. I ran the North American operations for this $100 billion Australian merchant bank. And basically we did everything there. It was a merchant bank, meaning we did foreign exchange trading, fixed income trading, corporate lending, asset securitization, money transfer, just about everything a large commercial merchant bank would do. After getting the organization to the point where I thought, I think we should have been, I had the opportunity to hook up with Frank Zarb, who our business school here at the university is named after. We had a similar acquaintance at Price Waterhouse. Frank was looking for someone to help him in the capital markets. He had just taken a position with the NASD, which was the main regulator for the broker-dealer community and still is, and at the time was the parent of the NASDAQ market. So he was looking for a partner to help put his vision into play. And I didn't really understand what that meant, to be honest. I was more a money market person being on the banking side, but Frank told me what his views were with creating a market of markets, and he needed someone to help him do that. So he hired me as his chief financial officer. And Frank was very good in terms of letting you take on as much responsibility as you can handle. So I was able to, fortunately, rise through the ranks pretty quickly there. He gave me the opportunity to take on additional duties. I became the deputy chief operating officer, which meant working with Frank to help run the overall company, run the NASDAQ market with him, in addition to obviously all the officers within NASDAQ, as well as an insurance company we had. Regulatory side. Shortly after that, he promoted me to Chief Operating Officer and Chief Financial Officer. We started looking at growing our vision of the markets. I don't want to get too complicated here, but we expanded the way investors can invest. The NASDAQ marketplace basically is an investing environment where traders and stocks trade through a network of computers. He wanted to offer people who were interested in being in the NASD world another way to have their stocks trade, the traditional floor-based environment. So we also purchased the American Stock Exchange. After we made that purchase, I became the chairman and chief executive officer of the American Stock Exchange. But I also had these other jobs. I was chief financial officer of just about everything, literally everything, and the chief operating officer. And we agreed that I would then become vice chairman of the overall corporation and chairman and chief executive of the Amex. So I've been very fortunate to have very good opportunities, and I'm very thankful for those opportunities.
After you left Wall Street, what came next?
Well, back in 2005, we agreed strategically that it was a good thing to sell the American Stock Exchange. So after a good amount of time of looking at various potential purchases for the Amex, we completed a sale at the end of 2004. I stayed on with the Amex for a while to keep transition for the new owners, and I decided to retire from Wall Street. And I happened to be chairman of the board at Hofstra University at the time. And a number of people on the board and some of the people I knew here had asked me to consider going on faculty here at the university. They had asked me that many times before, but I was a little bit busy. I couldn't do it. So I did go into the classroom, and I found it to be an incredibly rewarding experience, and I've been here ever since. The faculty had asked me to consider becoming dean of the business school, running the business school here at Hofstra. So I did become, within a year of coming on faculty, dean of the business school here at Hofstra. And after doing that for a few years and achieving a number of the objectives we wanted to get done, the president has asked me to work with him in the president's office. And now I serve as senior executive advisor to the president, taking on a number of duties throughout the university. So I'm back where I started. Came here, beginning here at Hofstra University as a student, and I'm back, right back, helping students hopefully find the path they're looking for.
It starts in the classroom and it ends in the classroom.
Absolutely.
Too. Our topic today is risk and return, something that fascinates me because all my buddies tell me I'm a very conservative kind of guy, so I'm looking forward to some of these answers today.
Sure.
And as I said at the outset, our format's a little bit different today. We're going to have our students here at Hofstra University ask the questions. And the first one is about risk and return, and I'm going to turn to Gus to ask that first question.
Professor Sodano, can you please explain to me what risk and return is in the financial markets?
Sure, Gus, that's a good question. Really important, and it's even beyond the financial markets. A risk-return question applies to just about everything we do, and what I mean by that is, anytime you make a decision, there's an implication to that decision. If you made a good decision, you get pretty much what you're looking for. If you make a bad decision, you don't. And it works that way in the financial markets. When you make an investment and you look at something that has more degrees of risk to that investment, you would expect to have a higher degree of return. You should be compensated for taking on that risk. And the reverse is true. If you make an investment with little or no risk, you're not going to get much return. Let me be specific. If you were to buy a U.S. government security, treasury bill, treasury note, there's very little, next to no risk that you're going to lose your money. You'll know you'll get your principal and your interest. But you're also not going to be compensated very much for that because you're not taking on much risk. If you were to buy a junk bond or something with a high degree of risk where maybe there's a potential you may lose, you need to be compensated for that. So you'll earn a higher degree of return. Risk and return. Higher the degree of risk, the higher the return. The lower the degree of risk, you can expect to get a lower degree of return.
And now we want to pinpoint some of those types of risks. Chris is going to ask us our next question.
Professor, what types of risks exist in the financial markets today, and which types provide the greatest adversity for investors?
That's a good question. I appreciate that one. There's all kinds of risks in the marketplace. Let me go through a few of them. The economy risk, that the economy is just not doing well. That may drive down how the marketplace is looking. Credit risk. Someone doesn't pay back the money that you expect to get, or whether that's principal and or interest. Interest rate risk. If you hold a security that's an interest-based security and the markets move, interest rates change, that has a direct change on the value of the securities you're holding. So there's risk in interest rates changing. Market risk, which means a whole bunch of stuff. Volatility, people aren't feeling good about things. The risk that the market may move once you own an investment. Political risk. What we're seeing right now with the government is having a very difficult time being able to make decisions. That moves people's mindsets in terms of what they should do with their money. Financial risk, which relates to foreign exchange risk. You may have an asset that's based outside the United States. As exchange rates move, the value of that asset is going to change. Are you willing to take on that risk? Liquidity risk. When you want to sell something, is there a ready buyer to be able to sell that asset to? Maybe it's an illiquid marketplace. Are you willing to take on that risk? Inflation. Maybe your money is going to be worth less. Business risk. Could be a perfect scenario and all the other risks, you're happy, and the CEO just fails to execute on the plan that you thought was a good one. So you can see when you invest, there's all kinds of things that can change. It doesn't necessarily mean bad. It depends on how you position yourself with those investments. You just need to be aware of all those different things that can happen, and there are more than that.
Mr. Sodano, I'm going to ask you a follow-up question to that one. Rank order, greatest risk to least risk, the list you just gave.
Boy, that's a pretty tough, that's a tough question. I guess the easiest way to answer it right now is anything that creates a lot of uncertainty gets people very nervous. And what we see right now is political risk is at a very high level. We're waiting for our government to determine what the landscape will look like in the future. Corporations cannot plan, they cannot make hiring decisions, they cannot allocate capital the way they'd like to. Maybe there are capital or dividends they'd like to distribute or bring into the country. There are many, many decisions that have to be made in terms of what the tax structure of the country looks like. So anything that creates that level of uncertainty, to me, is probably the highest degree of risk. The others can all be managed, whether it's credit risk. You have to make a good decision as to whether or not you did a good job of understanding who the person you're engaging with regard to that investment. Do they have the ability to pay? Will they pay on time? There are people to help you do that. There are rating agencies. You need to do your homework. Stocks are, for the long term, the way really to create wealth, in my opinion. There's no greater way to create value for yourself over an extended period of time, but you also need to have the stomach to withstand the movements in the marketplace. For many people, that's not something they're willing to do, but if you can, there's degrees of risks within stock, right? You can have stocks that are not as risky and some that are very risky. So within any of asset classification that we talk about, there's always further degrees that risk can be analyzed. So That's the way I'd look at it.
Good, thank you. Our next question is something all our investors want to know out there, potential investors, and Nick is going to ask that question.
Professor, can you explain what risk and return trade-off is?
Sure. Risk, a very good question. I'm glad we brought that up. And it's pretty simple. And basically what it means is, what is your appetite to take on risk in relationship to what you really want to earn? If you want to make a lot of money, you have to be able to say, okay, I'm willing to take on more risk to do that. In the marketplace, in financial investments, no one is going to give you a lot of money if you're not taking on risk. Give me an example. If you buy a U.S. government security, you know you'll be paid back your principal and interest payments will be made to you. Virtually no risk at all. Certainly that's the way we see it today. In return for that, it's reasonable, and the way the markets would work, that you're going to get a very small return for that type of an investment. Let's look at what's current in the marketplace today. If you were to buy a similar investment from Greece, a Greece government security, well, you may not get paid back, right? So you can expect and should get compensated for that extra degree of risk. So it's a trade-off. Are you willing to assume more risk to get more return? I like to say, can you sleep well at night when you make your investment? If you're up all night, that tells me that you're probably taking on more risk than you really should. And risk, return, trade-off, it's all really up to you as an investor how much risk you're willing to take, and you can expect to get the related return for that risk.
Thank you, Professor.
You're welcome.
I think that loss of sleep is a great yardstick or barometer of what risk and return with trade-off is. Our next question is a current events one in these turbulent times, and I'm going to ask Megan to ask that one.
Professor, do you believe that investors have become more risk adverse in recent years?
Thank you for that question, Megan. There's no doubt that that is true. Investors have become more risk averse for two primary reasons. One, not that long ago, we just went through the financial crisis of 2008, where unfortunately our marketplaces here in the United States and around the world froze, almost blew up, and we came to our knees with regard to how the markets worked. People saw their investments plummet down to maybe 50% of levels of what they were. If you had the stomach to hold on, fortunately much of it would have come back, and probably all of it came back, but many didn't. And that experience has burned a negative feeling for many people in their minds. So I think you'll see that certainly in the retail investor, there's a little bit of, more than a little bit of skittishness in terms of how you invest your money. Then again today, even though the markets have pretty much come back to where they were before the financial crisis in 2008, there's a large degree of uncertainty. Our government needs to provide definitive answers for investors, for companies, for CEOs, for all of us to be able to make educated decisions. Here's an example. Contemplation of how dividends will be taxed. Right now, dividends are taxed at 15%. You need to know that if you're going to make an investment in equity securities. That may very well be part of why you invest in equities. If things are not decided by the end of the year, the tax rate on those dividends will go up to 45%. Big difference, 45 and 15%. Does that have an implication on how you will invest? Certainly it does. Another reason why you're going to be skittish in terms of how you invest. So right now the markets, I'd say, are primarily professional investors who are managing money for pension funds. Certainly there are retail investors, but not the way it was before 2008.
So what I think you're saying is that potential investors have to stay informed or get a crystal ball. What are the two things, right? You need to know.
I wish we can buy a crystal ball. I'd be the first one to buy one.
I'll be the second.
But there's no question you need to be informed and educated and know the level of risk that you can tolerate. You know, what is appropriate for you. Fortunately, financial advisors do have an obligation to work with you in terms of what's appropriate for your situation, but no one is more responsible for you than you. So you need to be sure that when you put money at risk, you're okay with taking on that risk.
And that answer segues perfectly into our next question about diversification, a term we hear a lot about. Ali is going to ask that question for us.
Professor Sodano, can you please explain what diversification is and how a typical small investor would achieve diversification?
That's a really important concept in investing. Diversification, pretty simply stated, is not putting all your eggs in one basket. Say you were to do that and something went wrong with that particular investment. You've just lost everything, right? Let's go back to the days of Enron when the employees of Enron put pretty much all of their pension money, their 401k in the company stock. The company went out of business. All those people pretty much lost everything they had. That's not an example of diversification, right? Diversification means spreading your investments over a wide range of asset classifications. Cash, fixed income, which means bonds, stocks, maybe alternative assets. It could be real estate, it could be commodities, it could be a bunch of different things. It's spreading the risk so that no one category is going to really severely hurt you. You spread the risk. And as an individual investor, a new investor, there are a number of ways you could do that. One I'm proud of is something that we at the American Stock Exchange brought to the marketplace, something called an exchange-traded fund. We started with something called the Diamonds and the Spiders, which basically is an index security on how the marketplace moves. One, the diamonds was how the Dow Industrial Index would move, and the spider would be how the S&P 500 would move. Great way to diversify. You're not buying any individual security. You're buying the whole marketplace with one trade, right? So those would be an excellent way to buy a whole bunch of things with one transaction. Mutual funds. There are all kinds of mutual funds. They've been around for a long time. It could be a specific mutual fund for equities, but they'll buy a bunch of different equities. It's not just one security. Or maybe it's a combination of things. It's a mixed basket of securities in a mutual fund. Maybe it's a combination of equities and fixed income, or options, or different things. So there are many ways an investor, whether you're new as a novice investor or a highly sophisticated investor, to make sure you can diversify and protect from putting all your eggs in one basket. Not a good thing.
Who can best advise you on making these decisions that you're talking about right now?
Well, it depends on your own degree of sophistication, obviously. If you have spent a lot of time learning about how securities work and how the marketplaces work, and you're current on events, and you know the implications of government decisions, and you've studied the individual companies that you may buy a security from, you're pretty much in a reasonable position to make a good decision or have investment discussions with someone. But most people are not like that. The vast majority of people are not like that. So you will need to look to someone who can advise you. So you go to a properly licensed financial advisor, hopefully for a very good from a very good company, and you lay out for that person what your risk parameters are and what your goals are. Where do you want to be in a certain amount of time? And how much risk appetite do you have? After you and that person have that discussion, you lay out a plan. And you work on that plan, and that's probably the best way to do that.
Any tips for finding a good advisor? Do's and don'ts?
I think you need to look at the reputation of the firm you deal with. There are good advisors who are from very small firms, and there are outstanding advisors from very large firms. I think there's no real one set answer. Basically, you need to do your homework just like any other decision. Look for the reputation of the firm, and equally important, the reputation of the individual.
Right. And our final student question ties in with investments. Joe, if you'd ask that question for us, please.
Professor Sodano, my peers and I would like to become first-time investors. What advice do you have for us?
Well, I have two points I'd like to make. First, you really have to do your homework. Know what it is that you're investing in. You don't buy something just because you think it's a good idea. You have to know what you're putting your money into. Second is to understand the difference between investing and trading. People confuse that. They're not the same thing. When you make an investment, you're looking for something to grow over an extended period of time. It doesn't mean forever, but a longer period of time. Trading means you're buying and selling for the purpose of making, hopefully, quick profits, or if you made a bad decision, a loss. Sort of like you see on TV with all the traders running around. They're not investing. They're buying to make money right now. So first thing, know what it is you're investing in. Understanding what your own risk parameters are. How much you can put at risk. make sure you diversify the degree of risk you take on, and start slow. Do your homework, understand what it is that you're buying, and hopefully you make good decisions.
Mr. Sodano, I get to ask the last few questions. What advice do you have for our high school students who are considering a career in business and finance?
Well, the first thing a student should do is make sure they really have a strong appetite for understanding what business is. Learn everything you can. Read as much as you can. Look at the Wall Street Journal. Look at the financial channels on TV. Understand how the markets work. Understand what business is about. And you'll know if this is something you like or don't like. Then once you do that, you have to have sort of a tremendous curiosity and appetite to gobble up as much information as you can about business and try to figure out where within the business world you want to land. If it's in the world of finance, if it's in the world of management, there's a lot of different things you could do in business. Look and learn as much as you can, talk to people, but do your homework just like anything else.
And what are some of the specific skill sets a person needs to be successful?
Well, I think it's pretty common to just about anything you do in life. You need to work hard. You need to get outstanding credentials. You need to compete against a ton of people from all over the world. You know, the financial market jobs are probably some of the most competitive in the world. So you need to make sure you really prepare yourself as best as you can. Undergraduate degrees, when you go to college, finance is important if you want to be in the financial world. It's a little difficult to have a degree that's not related to the world of finance and then get in, although that's not impossible. It does happen. But again, you're competing. So you need to prepare yourself as best you can to compete as best as you can. So a degree in finance, participate in clubs in the university, meet alum, meet your professors, learn and network yourself, and work as hard as you can. The old saying is the harder you get, the harder you work, the luckier you get. That really is the way it works. So you need to work very hard, do as well as you can in school, have an endless curiosity and appetite to learn how the business world works, meet as many people as you can, and hopefully you land where you want to be.
And finally, in terms of that academic preparation, both in high school and when our students get to college, what advice would you have for them?
I think it's anything that helps your analytical skills are important. You know, people will say, "Oh, I want to be a financial guy. I should study math." Yes and no. You know, that's probably true. The analytics related to finance certainly involve mathematical application, but it's way beyond that. It's understanding the basics of business. There are courses in high school you could take right now on how business works, on just like this series we're doing right here, helping people understand how finance works and investing, even in high school. If you think you might have an inkling towards doing that, those are the courses you should take. And that would then carry on to your work in undergraduate school and hopefully in graduate school. And the rest then is a combination of incredibly hard work and some degree of luck, and hopefully you meet with success.
Mr. Sal Sodano, I want to thank you for being our guest today. Teachers and students, I want to thank you for inviting us into your classrooms. For Minds on the Markets, I'm Steve Cusin. Ciao.